Isn't it a bit late to talk about fixed income? Haven't we passed the peak of interest rates?
We're most definitely past the peak of interest rates. In fact, you could argue we're at the trough of interest rates. But I think what we would say is it's time to think differently about fixed income and how that fits into your portfolio and how you manage your portfolio. So in the past, you could sort of buy your bonds, hold them to maturity, you got a very good return. Now by holding them, it's likely that as interest rates rise, you're going to experience capital losses.
So that means you've got to be more active.
You've got to be much more active, and you've got to get away from anchoring yourself to a traditional benchmark. So starting from LIBOR, starting from cash.
So where do you see the return opportunities?
Look, I think we think of it both from being on the long side as well as being on the short side. I think in the US, on the short side, as US Treasuries rise, that you can make money out of that. On the long side, by owning things like high yield bonds, you can get reasonable returns, right? Yes. Again, we've got to calibrate that we're in a very low yield, low return environment.
But if you're in high yield bonds, does that mean corporates or countries?
It's corporates. We're focusing on high yield corporates, right? Yes. Again, the balance sheets of those high yield corporates, particularly those focused on the US economy, are actually in very strong shape. Yes. So they've termed out their debt, their credit quality's improved, and they're in the point where they're likely to see credit upgrades, very low default rates. All of those things are positive.
Yes, but defaults are very important because in that game, as it were, default rates are the key to success, and clearly the lower the default rate, the better this. So you must be doing a lot of research in that area.
Yeah, we have 70 people focusing on corporate credit. So you're right, the critical piece is to avoid those defaults. Last year there was less than 1% defaults in the high yield market. Historically there's around 4%. This year we think about 1.5%, but the credit analysis is focused on making sure you avoid those losers, and that's going to make a big difference to your total return.
And your research is solely focused on the corporates from the debt side, has no reflection on the equity side, is that correct?
Yeah, we have two independent teams, so the fixed income team and the fundamental equity team. Now, the advantage is that they certainly talk and share.
They're in the same
research.
building, are they?
We're in the same building, we're in the same floor. So there's a lot of interaction between them. But of course, at the end of the day, what the equity guys are looking for, growth, investment is good for an equity story, but it may actually put the debt story at risk. So often we'll have the same conclusion, but have different investment implications.
And what about industries? Are there any particular industries you would follow for that purpose?
Yeah, we're looking at those that are generating strong cash flow. So we like the sort of the pharmaceutical area, healthcare. Those are areas that we think have generated strong cash flows, and those are the things we're focused on.
There are enough issues to follow in that area.
Yeah. Look, the high yield market is very large, particularly in the US. It's much smaller in Europe, and it's a little more concentrated around financials. At our focus at this stage is more in the US. We think the European high yield market is developing. There will be some good opportunities over the course of the next 2 or 3 years.
And you're talking about the European corporate high yield, again, not the sovereigns.
Sorry. European corporate high yield, precisely.
Yes. And if you're looking at that market, you have also a currency play to take into account if you're looking back to a US denomination.
Correct. Yeah.
Are you sort of concerned about that, or is that not a big issue anymore?
Look, we tend to hedge the currency risk in bond portfolios. Obviously currencies are more volatile than bonds are, so if you are taking currency risk as well, you tend to increase the overall risk of the portfolio materially. So we would typically own non-US issues hedged back into the US dollar.
And therefore what you're trying to get is a fairly steady return, would that be the right?
Yeah, I think that's a nice way to characterize it. What we want to do is generate consistent and persistent returns for our investors.
Nothing too spectacular.
Yeah, look, we want to make sure it's outperforming benchmarks, outperforming our competitors, but it's also avoiding those defaults. So I think those consistent returns are what keep investors coming back.
If I look over the last 5 years, say, and look forward over the next 5 years, what sort of returns will we be talking about?
Well, the 5-year period is an interesting one because that's just after the financial crisis.
Yes, exactly.
You look at high yield returns, they've been nearly 19% over the last 5 years annualized. So phenomenally strong returns. We certainly don't think you're going to experience 19% return.
That's disappointing.
I'm sorry to say that. Over the longer term, so if you look over the last 25 years, high yield has generated somewhere around 7.5% to 8%. And it may be a little bit below that in the next 5.
For that that sort of time period, that's pretty good returns.
Yeah, no, it's been very good returns. There's volatility around that, so through the periods of 08, 09, and as we go forward, I think we're looking at returns somewhere between 5 and 7%. The current coupon on the market is around 7%. So I think it's perfectly achievable, those mid-single digits. It's just not going to be as spectacular as we had in the past.
How dependent are these returns on ultimately the stock market performance?
Well, high yield is not very highly correlated with the stock market. It's relatively highly correlated with growth, and so as long as growth is okay, that will be fine. It's also relatively immune from rising rates. So we certainly think US interest rates are rising, but it shouldn't be enough that would impact the returns.
Have you got a date when that will start to happen?
Yeah, we think in the second quarter of 2015, right? So we'll see.
So we've got a little way to go, yeah?
Yeah, we have. Markets obviously anticipate. So as we get towards the end of this year, suddenly that first rate hike, and it's been a long time since the central bank has risen rates.
You don't expect that to cause a shock to the system?
I think some of that shock is happening. It happened last year, but I think we still, as the economy gets better and the probability of that hike goes up and the timing comes closer, then yeah, we expect to see Treasury yields move higher. I don't think we expect to see a shock because people are so focused on this.
So you're very positive about the opportunity in this particular area?
Yeah, well, I'd say reasonable single-digit returns in the high-yield market seem good, and then the ability to underweight things like US Treasuries, you can add additional returns. So this flexible fixed income approach we've been talking about is actually a good way to generate those consistent positive returns that are going to be elusive if you just hold on to longer maturity governments.
Andrew Wilson, thank you very much.
Thank you.